But we do think that the rest of the U.S. economy, there's some trends that are being ignored. The number one, the number of bankruptcies, companies with 100 million of debt or more, the number of Chapter 11 bankruptcy filings is actually the highest since April of 2020. And actually, probably by next month, we will be at the highest number of bankruptcy filings on a monthly basis since 2010. And I don't think that mainstream media is actually focused on this information.
We're starting to see a dramatic increase in the number of companies across America filing for bankruptcy. What's going to happen to the labor market as a result of this trend? What's going to happen to the economy? How will the Federal Reserve likely respond to this? And what's going to happen to the markets as a result later on this year? We're here to examine these questions and more with Jay Singh. He is the founder of the Special Situations Research newsletter, who has spent several decades on Wall Street working as a fund manager for several firms, including Goldman Sachs. Jay, welcome to the David Lind Report. It's a pleasure hosting you.
David, pleasure to meet you. Thanks for the opportunity on a Friday afternoon before our 3-day weekend here. Calling from Palm Beach here in Florida. Happy to be on here with you, and I'm sure there are a lot of interesting things that we're going to cover on this.
So Jay, it's your first time on the show. Why don't you give us an introduction to yourself and your work, and give us a bit of background as to what you were doing prior to launching the Special Situations Research newsletter?
Sure thing. So my parents moved here in the 60s, and as a son of immigrant parents from New Delhi, my dad actually lived in a basement of a restaurant, Hell's Kitchen. So growing up as a first generation Indian American was tough. And that was when New York wasn't as nice as it is today. But I worked hard, was a competitive athlete through school, got a full scholarship to Penn University, and quickly found my way in the family office business. I worked at a couple international equity long short hedge funds, did a little bit in the banking space and in the private equity space before finding my way into a seat at Goldman Sachs. Went through their training program, was promoted there, and it was essentially covering a unique area of investing for them called distressed debt investing, capital structure arbitrage, and event-driven equities. So everything from spin-offs, split-offs, merger arbitrage, dual class share arbitrage. If there are index inclusions, essentially finding very interesting opportunities, including REIT conversions and MLP conversions, where your returns are less correlated with the market, and you're trying to harvest alpha by looking at specific asset classes in areas that are not covered in mainstream media. I've also been a professor at universities, so my focus personally, probably for the rest of my life, is going to be education. Whether it's education about basic savings and financial management, or how to delve into a cap structure and dissect it, how to value a company. Those are things that I found really interesting, and I've dabbled a little bit in the macro, which can be interesting, but it's not my focus.
Well, certainly lots to discuss today, and I know that you've chosen to keep your camera off. That's by choice, not because your camera's broken.
That's right.
That's okay. Is there a particular reason as to why that you could share with us?
Early in 2020, I was very negative on certain asset classes and started to express my views. Actually, I was one of the biggest short biased investors in the SPAC space in 2021. So companies like Joby, air helicopter businesses that were pitching 2027 EBITDA estimates, along with crypto. I was short a lot of names. I had very strong opinions, and got a lot of threats because of it. From SPAC sponsors, from owners, from crypto aficionados. So, as being retired, I don't really need to be out there in that way. I don't want my family to be involved in that type of stuff. So, just focusing on the research. That's all I enjoy doing.
Yeah. All right. Well, guys, if you're watching this, stop sending people hate mail and threats. You're ruining it for the rest of us. It's not cool, but I appreciate you being here nonetheless, Jay. So let's start with talking about some major risks that investors are Well, that should be impacting investors. You were telling me offline that you've noticed, for example, that bankruptcies are reaching a 3-year high. You're looking at the stats. Let's start with that. So tell us about what you've been looking at.
Sure thing. So, we have a bifurcation in the United States markets. So it's basically seven stocks in the United States, S&P 500 index, have driven the majority of market returns since April of 2023. And, those names include Microsoft, Google, Facebook, Nvidia, AMD. And, what we think is happening right now with the VIX at 13.5. The VIX is a risk measure. You can't actually trade it. People trade the futures, but it represents front month at the money volatility, um, from 20, let's say, to 35 days. Um, and that index is at, multi-year lows, basically at pre-COVID levels. And that combined with the record call buying we had today, Friday, which was the June OPEX, was the highest amount of call buying in recorded history. So we think that there is a lot of investor complacency, and the market is a forward discounting measure, and the market does climb a wall of worry. But we do think that the rest of the U.S. economy, there are some trends that are being ignored. The number one, the number of bankruptcies, companies with 100 million of debt or more, the number of Chapter 11 bankruptcy filings is actually the highest since April of 2020. And actually, probably by next month, we will be at the highest number of bankruptcy filings on a monthly basis since 2010. And I don't think that mainstream media is actually focused on this information. And then number two, I think the consumer is also very stressed. I think that the number of individual bankruptcies and rent deferrals and evictions is probably going to increase after moratoriums have now lapsed. And we're likely going to see unemployment levels climb. And the record, 3-4 trillion of savings is now, that we had during COVID, and the 7.5 trillion of wealth creation in the real estate market, and the 1.5 trillion of wealth created in 401ks, is probably going to be challenged if we enter a recession in the second half of the year, along with the fact that people are going to have to pay their student loans for the first time in 3 years, starting on October 1st, after the debt ceiling negotiations. So
The highest amount of.
Go ahead.
Sorry, please continue. Sorry, go ahead.
So I think that, if you are an average American, earning, below 70K, and, you're struggling to meet your rent, your medical payments, your utilities, and prices have been going up, 2 years in a row, and at the same time, wage growth is lagging. And I think the wealthy that speak on Twitter, that own assets, that are serial entrepreneurs that usually lead spaces and podcasts, might be disconnected with the reality of what's happening in middle America. And you can see that credit card borrowing levels have risen. If you need to get a car loan at a dealer, it's going to cost you 13% if you don't have a perfect credit score. There are a lot of leading indicators in diffusion indices, PMIs, that you can look at to see that things are not great, and the global economy is slowing down. And even China, that was supposed to have a recovery, is now rumored to be planning a stimulus because their May economic data was far below expectations, and actually was a negative on a month-over-month basis since April.
Okay, I'm just going to go back to the bankruptcies for just a minute. That I find that astounding that it's the highest. It will be the highest since 2010, considering that during 2020, when the lockdowns were prevalent, we had a surge in bankruptcies, especially among the smaller businesses. From the data that you've looked at, what types of businesses have been filing for Chapter 11? Are they small businesses or were larger ones? Which sectors?
So there's zombie businesses like Bed Bath and Beyond, for example. So if you look at data from the American Bankruptcy Institute, it tends to be less informative because they include very, very small businesses in their analysis. But the data that we're looking at, is tradable credit. So private credit, leverage loans, it's a $1.4 trillion industry. And, middle market loans and, companies with, 100 million outstanding of debt, those bankruptcies we think are going to climb through next year. And I think by next year, there's a high probability that we'll have a 5% default rate across the leverage loan index, specifically because of the fact that, one, during COVID, you had the Federal Reserve come in with stimulus right away. So companies that had to file never filed. And those what I call zombie businesses that just added on debt. You look at the cruise lines, I'm not saying the cruise lines are at risk, but it's just an example because they're publicly traded. And the airlines, they all tripled their debt levels, right? And with interest rates higher, as those companies have to refinance, it'll be more difficult for them to operate their businesses. So just like you refinance your home, companies have to refinance bonds. Bonds are usually issued for 5 to 7 years. During COVID, a lot of maturities were pushed to 2025 to 2027. So just like in commercial real estate, there's a like you're seeing an almost every 2 days you're seeing a large bankruptcy because they have a maturity wall 1.5 trillion this year and next year. In the corporate space, the maturity wall is from 2025 to 2027. So what that means is by 2024, companies preparing to refinance their debt, they all plan a year in advance because these are not easy refinancing conversations. Companies that were borrowing at 3, 4, 5, 6% that are now going to borrow at 10 to 13%, may not make it. And so they may have to restructure or file for bankruptcy. And it's going to be as soon as 2024. I think 2024 is going to be one of the biggest years for brands filing for bankruptcy that you probably know that we've seen in a long time. In fact, there was one just yesterday. We have a community of 1,200 traders on special sits research, and we get a constant flow of information. So just yesterday, Pyrex, the instant pot company, which if you're a cook, you're probably familiar with, just filed bankruptcy. And that was just a couple of days ago. So any company that's related to financing or consumables, we are in a global goods recession. So if you look at manufacturing PMIs, at between 46 and 50 across every developed economy, Germany, US, China, they're showing that manufacturing is in decline. And we think that the service economy will slow down by the end of the year and next year as well.
During the pandemic, it was very obvious why certain brick and mortar stores were shut down, were closed down, because there was no demand. People physically weren't able to purchase their goods or services. Would there be a primary catalyst that would be responsible, you think, for the rise in bankruptcies that we saw or are seeing now? Could you attribute it to one
Absolutely.
or two things?
Absolutely can give you two things right off the bat. Number one, pull forward of consumption. So what you saw during COVID was, if you had a deck that you needed to refinish, if you wanted to remodel your bathroom, everything was pulled forward because you were at home. You didn't know how long you were going to be at home, if you would have time to oversee those tasks and projects. So you had a pull forward of everything related to the home and auto. And today, what is, I think, the spark for the next fire is just the cost of capital. So even if you're a good company today and you're a small business lender, you cannot borrow at under 12%. And if you are a bad company, which means that you don't generate free cash flow, you could be borrowing at 15 to 20%. And consumers today, because of where rates are, these credit card consolidation loans, everyone looks at Upstart. Oh, it's such a great company. These companies are helping the poor refinance. They're charging you 30% for consolidation loans. It is not easy to take on that type of debt. So we're not looking at Brazil where they actually have 300% annualized APRs with the CELIC rate in the teens. But in the United States, rates are close to usurious for basic needs. And whether you are a local government or a consumer or a small business, you are seeing demand come down and your revenues come down at the same time as your wage costs and your interest costs are going up. And it's this is creating is a margin squeeze. Margins peaked in 2021, 2022, above 13% operating margins for the S&P 500. That's just using public data, but they also peaked for private companies. And you are going to see margins compress for the next 2 years.
Okay, I want to come back to margins just a bit, but if you think that there's going to be a wave of bankruptcies, do you think that it's possible that we will get a supply shock in the sectors affected, pushing up inflation?
No, I don't think so. I think a lot of people don't understand how the U.S. bankruptcy system works. So, the concept is Chapter 11, which a lot of countries don't have the formal bankruptcy system like with the United States. But when a company files for bankruptcy, it doesn't go away. What it means is the creditors will take over the business, the equity will be wiped out, and they'll fire a lot of people. They'll cut costs, and they'll try to emerge after Chapter 11 as a smaller organization. So the business, if it produces, if it's a candle maker that's going through a rough time because people are now going to the office and they don't need to buy as many candles as they did before, the business won't get wiped out. They'll keep their operations. Maybe they'll cut a deal with the debt holders for them to take a 50% discount. So the interest expense is lower. They'll probably have to find a new owner because the equity guys will get wiped out. And the business will operate at maybe 50% capacity, 20% capacity, what it was doing before.
So knowing this, what does this mean for equity investors? Should we be staying away from the markets, or is this going to present opportunities for buying in things at the cheap?
Well, it always creates opportunities, but it also means to avoid businesses with a lot of debt. So if you're looking at a company with over 5 times leverage, you might have an opportunity to buy that business, 50% cheaper. Or if it files for bankruptcy, you might have an opportunity to buy its debt claims, and convert those into equity and buy the business at 10% of where it was trading before. It really is a case by case analysis. And the companies that don't have any debt, like the Microsofts of the world with very clean balance sheets, they could arguably continue to run for a short period of time until, the headline numbers are so bad and earnings are so bad that things turn over for the broad economy. But this is an economy in the United States that's much different than it's ever been. With tech being the majority of all the major indices, you can have part of the index do well while the rest of the index completely languishes. So you have to pick your poison. But for us, we think that there are much better opportunities given where interest rates are in hybrids, deep value, special situations. I mean, there's a company that we were talking about that paid a 40% dividend, right, in the agriculture space that people, probably think is a boring company, or prefs that have potential 35% returns where they're paying you 10% current and you're buying them at 60, 70 cents. And they're trading like that because interest rates are much higher than when they issued those prefs. So I think that there's a lot of copycat and groupthink when it comes to the markets today, especially with the speed of information and FinTwit. And it's really easy for someone to open the Robinhood account and buy 5 shares of Nvidia, but it's really hard to think about risk and reward and try to deliver lower volatility returns so that you can sleep at night. And you're also seeing a lot of option speculation, in companies like Tesla and companies like Nvidia. It doesn't mean that they're bad companies, but people care less about the price they're paying for businesses today. They forget that when you buy a share of a stock, you own a business, and you need to, pay an appropriate price for that business. And what we've seen is about 30% multiple expansion in the index with earnings going negative. So you've actually seen a complete disparity of about 30% between earnings and multiples, which we haven't seen in a long time. And you've also seen for the first time disparity between large cap and small cap stocks. The Russell 2000, if you adjust the Russell for companies that don't generate profits, which by the way, most people don't know that in small cap stock world, 60% of companies in the Russell don't even have GAAP earnings. But if you were to clean that index up for companies without positive earnings, it trades at like less than 12 times earnings, whereas large cap tech trades at 25 times earnings. There's a huge disparity in valuations, and there's also a huge disparity in the direction of interest rates in tech. That correlation that we saw for the last 2 years is completely broken because of this AI mini bubble that we're seeing.
Okay. Now, the risks that you've highlighted, have the bond markets shown any indication of these rising risks? Let's take the CDS, corporate default spreads, for example. Have they been rising?
Yes. So if you look at the ICE B of A US High Yield Index, which is available on Fred, the St. Louis Fed actually provides this information. It has kind of been in a range bound area. So back in 2021, it reached a cyclical low because the government had taken all the credit risk out of the market, with trillions of stimulus. It was around 300. During the gilt blow off and the economic volatility that we saw in 2022, it was kind of range bound, between, it was in the 500s, even getting close to 600. Today, before the debt ceiling, we're around 470. We're still in kind of the mid 400s today. So what the credit markets are telling you is that things are not hunky-dory, that the economy is slowing down, but we even think that the credit markets are too benign. We think that, the mid 400 spread is probably too low for the increase in bankruptcies that we're going to see. And we think, more reasonable spread for the environment we'll see next year if rates stay high is closer to 600.
You and I discussed this next topic at a Twitter space recently, but you had a great answer, so I'd like to revisit this topic, which is the issue of comparing interest rates today to the past. Now, some people have brought this to my attention, which is that, yes, you're right, interest rates, the Fed funds rate has risen at a dramatic pace, the fastest since the 80s, and a lot of businesses are finding it difficult to refinance. But keep in mind that all throughout, let's say, the 90s, for example, we've had interest rates at similar levels. Back in the 80s, we've had interest rates at even higher levels. And I don't know if we've seen defaults or bankruptcies to the same extent that we're about to see, right? So what's
Oh, we
different this
actually
time?
did. We actually did. Well, one, the economy is completely different. We'll get into that in a second. But most people don't know because you didn't have these many news outfits back then. But in 1978, before Volcker even joined, when rates were going up from 5 to, 10%, before Volcker raised them into the teens, you already had 10 banks fail. Before, this great, revered Federal Reserve governor had even become chairman, you had bankruptcies in the U.S. banking sector, and the number of banks has fallen from over 15,000 banks to about 4,500 banks today after the subsequent bank savings and loans crisis that happened in the 90s.
Interesting. Okay, so
And the
the
difference
economy, you're
between then and now, because that was the second part of your question, is that in the 70s, the United States was a manufacturing economy. We hadn't outsourced, to China and India, and we had a completely different labor economy. We had completely different demographics. Household formation was very, very high. People were buying homes and cars for the first time. Women were entering the workforce, and most jobs were not white collar service jobs. Like you wouldn't be getting a job at Facebook, you would be getting a job at a GM factory in Detroit, and that was one of the best jobs you could get. So, I think that that was 50 years ago. The economy today is primarily services, and the U.S. consumption is 70% of the economy. And what's driving the U.S. economy is consumerism and service jobs. And I think small business spending and consumer spending are both going to be falling in the second half of the year and next year.
would you say that interest payments, I'm generalizing here, but for the average company, interest payments today as a percentage of EBITDA are higher than they were, let's say, 20, 15 years ago?
Oh, absolutely. Both government debt and corporate debt is very high. And the reason why is after 15 years of zero interest rate policy, if you're borrowing at 1%, you can afford to borrow 10 times as much as when interest rates are 10%. Because most companies, they'll look at their interest coverage. If I'm doing $1,000 of EBITDA and I have $10,000 of debt and the debt costs 10%, that's $1,000 and that it takes all my operating earnings away. But if interest is 1%, my interest is only $100 on 1,000 of EBIT. So you can afford to pay that 10 times over. So interest is actually, 1% move in interest rates, even for the US economy, which has 31 trillion of debt. Now let's say, 7 trillion of that is at the Fed, we still have debt in the mid-teens and half of it is maturing over the next 2 years. So when you think about that, every 1% increase in debt for the US government costs US taxpayers $400 billion. And you can apply that same methodology on US corporations and US commercial real estate landlords.
So knowing this, Jay, let's say if you were the CFO of a company, would you be incentivized now to dramatically change your capital structure, meaning your equity to debt ratio?
Well, I would, but the problem is you can't. So most companies can only change their capital structure in two ways. You can either issue equity or you can refinance your debt. But it's too late to refinance your debt. You have to wait for the Fed to actually cut rates. And that could, for the Fed to materially cut rates could be sometime next year. So between now and between next year, a lot of corporate treasurers and CFOs, the only way that they can change their ability to meet their increased debt service payments, if they have debt, by the way, a lot of companies don't have debt, but the majority of US businesses have some level of debt. And if they need to pay that debt, the only way they're going to be able to pay that is not by changing their capital structure, but by changing their operating structure, which means that they need to fire people They need to cut their ad budgets. They need to spend less on small business needs like software, office supplies. I hear funny things about Masayoshi Son. He runs SoftBank, the biggest tech private equity firm in the world. And they're using single ply toilet paper right now to keep their costs low. And those are the things that people do to save, because you can't change interest rates. If Masayoshi Son had to borrow to do margin loan today, it would be twice as high as what he got 2 years ago.
You can't just issue more equity.
Well, you can issue more equity, but in this environment, you're going to have to issue it at a discount and you're going to have to do it at a valuation that's very low. So imagine you are a smaller mid cap business. Like we said earlier, the Russell 2000 is underperformed because it's really only seven stocks. Now, market bulls will say, well, all the other big name stocks have been dragged up as well. Yeah, absolutely. If Apple rallies 30%, there are going to be some other companies that rally with Apple. But there have been seven mega cap stocks that have driven this economy, the stock market up. But most small cap stocks have not moved that much at all. So if you have to issue stock today, you probably have to issue 3 to 4 times as many shares to get the same amount of equity dollars as you did just 2 years ago. So it's a tough pill to swallow. And also, for some companies, they're trading high because of short interest, not because there's fundamental value. So if they have to issue equity, they might be issuing equity like 20, 30, even 40% below where their stock's trading in order to get a decent size, unless they want to do like an S&P.
Yeah, that makes sense, Jay. And you mentioned that you think that the Federal Reserve may cut rates next year. We will see material rate cuts by next year. Okay, I mean, a lot
And
of
it,
people do
it,
share that.
it may not be, when I say material, I mean, material might be a couple cuts. That doesn't mean they're even going to cut rates to zero. So people, a lot of these zombie companies, I like to call them, that have been extending and pretending for years, in the retail space, and some of the third and fourth competitors in highly competitive industries that have a lot of debt. Those businesses, you have to think, are they going to make it? It really hinges on how difficult this next economic cycle is going to be, because eventually Powell is going to cave, but that Fed put, I think, is much lower than it was 5 years ago.
Let me ask you this, and I'm gonna come back to the duration of keeping rates high in just a minute. But at this week's FOMC meeting, Chairman Powell was very clear in saying that he does not think that rate cuts this year are appropriate. And in fact, none of his colleagues, none of the other board of governors or governors of the Federal Reserve, rather, none of them have indicated cuts for the rest of the year. Now, what would make them change their mind, Jay? What would force them to pivot?
I think three things would force them to pivot. One, general malaise in the U.S. banking system. So I think Powell in the last FOMC minutes stated that he expects commercial real estate, where we have 1.5 trillion of upcoming maturities, to weigh on the banking system because smaller regional banks tend to be over-indexed to commercial real estate versus the super regionals and the large caps. I think he expects that, but I think if it were to spread to some of the bigger banks, I think that would worry Powell, number one. I think number two, I think if the unemployment rate went above 5%, when approached 6%, which I don't think would happen until next year, I think that would cause more than three or four of the Fed governors to change their attitude completely. And then I think number three, an increase in credit spreads, which is a forward indicator for default rates. And default rates are forward predictors of bankruptcy and unemployment. They keep an eye on this data. And they speak with Larry Fink of BlackRock, who manages $10 trillion. They have meetings with the New York Fed all the time. I think those three indicators are three things to keep an eye on, because I think the Fed is watching them very closely.
Mm-hmm. People have pointed out that it's very rare for the Federal Reserve, historically speaking, to pause and then hike again. In fact, I think the 80s was the only case in which they did that in recent history. Do you think that history is a good guide for the future, meaning that if the chances are that they won't, if they haven't been raising after a pause before, chances are they won't do it again this time?
Well, I think what the Fed is doing is they're being data dependent, and I think Powell has been very clear about that. He is a more eloquent speaker than Bernanke, Yellen, and Greenspan before him. But what I would say is that the minutes were very hawkish. They paused, in my opinion, because the Fed, after the debt ceiling was raised, has to issue about $1 trillion of bills, and they have to refill the TGA, the Treasury General Account, so that they can pay contractors and Social Security and the U.S. military. And it didn't make sense for Powell to raise, you know, and just charge him the Treasury, which is still part of the U.S. government. The Fed and the Treasury are different, but they talk every day. Yellen speaks to Powell every day. So when it came to Friday, I'm sure which is when they decide what the SEP is, and we have a lot more information about the Fed than we ever had before. I think they saw the U.S. stock market and they saw that liquidity conditions were loose. They saw U.S. credit spreads are kind of in that mid 400s area, not too crazy, and they decided that they're going to have a hawkish SEP, which means that they raised the terminal rate to 5.6%, and at the same time, they paused. And I think it was strategic because I think Powell saw the market and he was like, I don't want to say that we're pausing and let things get out of hand, because the biggest risk for Powell and his personal reputation, because he doesn't care about making his government salary or losing his job. He's a multimillionaire. The thing that he's worried about is becoming the next Arthur Burns and being blamed for creating high inflation expectations. So I think in his opinion, he wants the market to believe, which it didn't. In April, we had 4 cuts priced in for this year, believe it or not. He wants the market to believe that there are going to be no cuts this year.
Okay. So if you had to place trades or bets on rate direction, which direction would you take? The no more hike camp or the 1 or 2 more hike camp?
So in reality, given where rates are today, if you just take 25 bips, for example, and you divide it by, you know, 500, right? That's a 5% move in interest rates. It's very small, right? So the effect that interest rates are already having on the economy means that the economy is going to slow down no matter what he does, whether he holds them or he increases them. And I frankly don't think it matters. What matters more is the actual communication and delivery when they have the meeting in July. And I think that the FOMC hawkish surprise, I didn't think it was a surprise. I actually expected the SEP, and I was on a space just 2 days before where we were discussing that with a few thousand listeners. But what the Wall Street thinks that this was a FOMC hawkish surprise. It's funny that the market didn't sell off much after that. But I actually think that there is a decent chance for a July hike, especially because the market essentially bounced after the initial sell-off after what was a hawkish meeting. The market seems to be challenging the Fed and questioning the Fed. So I think that there is an over 50% probability that we'll probably see a 25 bips hike. And to your point earlier, I mean, the Bank of Canada and the Bank of Australia, the RBA, they both paused and then they hiked last month. So in this cycle, it doesn't seem to be very strange for central banks to pause and then hike again.
Well, the futures market certainly agrees with you. The CME Fed Watch tool is pricing at a 74% probability right now on Friday afternoon of 125 bips hike by July. I think the market, and I guess yourself, you would be assuming then that the risks of higher defaults, higher bankruptcies, higher unemployment, that's not going to happen within the next 30 days, right? This is more of a long, drawn out process.
It's happening right now. It's happening as we speak.
Right.
You're seeing, I look at all sorts of data. The latest data I was looking at was, cable cancellations, people canceling their MVPD subscriptions. So it's Charter, Comcast, Altice, Dish, DirecTV, and they reached the highest cancellations in recorded history. In the first quarter, just for Dish alone, you had 522,000 subscription cancellations. That's 6,000 per day for the quarter. So the consumer is definitely weak. Businesses are definitely seeing lower demand. And I think bankruptcies are going to accelerate all throughout this year, next year.
Right. So let's assume that the Fed's looking at this data. I don't know if they are, but you brought up a key point, which is that they don't need to raise rates by 25, 50 basis points.
They don't need to raise rates at all for
right,
more
exactly. I mean, the point that you made, which is a good point, is that high rates already are causing problems in the economy, correct?
Right.
And so 25 basis point up or down, the economy is already going to see breakage. And so the question is, why then? Why do they need to feel compelled to even signal more rate hikes? Keep in mind, CPI has already been coming down.
Yeah, it is very interesting. I think that this cycle has just been different than prior cycles. And, you know, there was a graph that one of my colleagues shared with me from Haber Analytics this morning, and it's a very interesting graph. I think a lot of people would benefit from sharing the insights from it. Um, and I'll share it with you after this. But in the last 13 credit cycles, where the Fed was raising interest rates and we saw higher defaults, only three of those were soft landings. And 10 of those resulted in large declines in markets and higher bankruptcies. And I think the Fed is looking at this cycle and they're saying asset classes are all near highs. Real estate prices haven't fallen that much in the United States. Equity markets haven't fallen that much in the United States. Credit spreads are higher, but they aren't really that difficult. Most of the cost of capital that's making borrowing difficult is actually from the base rate, not the credit spread. And the average decline from the date, of a Fed pause to the ultimate low in the S&P 500 over the last 7 market cycles actually been 25%. And usually there's more volatility going into the pause. So I think with the VIX at 13 and a half, the Fed is looking and saying, have people learned from their mistake? You already have, Operation Choke Point 2.0, crypto's fallen, but, to the two biggest asset classes in the United States, residential real estate and stocks, many are making new all-time highs. So what the market is actually doing is giving the Fed more room to keep rates higher, to see increases in unemployment so that the labor slack widens. Because once you see more labor slack, wage inflation will slow down. And I think Powell wants wage inflation to slow down. And he said it in multiple meetings. Until we actually see that, it will always mean that inflation can come back from his perspective. So what I think is, people are getting too excited and they're all kind of trying to front run the pause. But one thing to note is that in the last 7 cycles, the buying the market after the pause or buying the market even after the first cut, for example, September to December 2007, okay, that was the first cut. The market fell 50% from that cut. From May 2000 to January 2001, okay, the market actually had the Fed paused and the market collapsed. And it actually bottomed in October of 2002. From May 1989 to July 89, the Fed actually paused, but the market didn't bottom until 12 months later in July of 1990, in October actually 1990. And in October of 1981 to September of 81, you had a pause. The market didn't hit its low until August of 1982. I can keep going. December of 1979 to January of 1980, the Fed paused. The market didn't bottom until March of 1980. In July of 1973 to August 73, the Fed paused. The market didn't bottom until 14 months later, October of 1974. And from August 1969 to October 69, the Fed decided to pause in the market. The recession didn't start until December, and the market didn't bottom until May of 1970. So it's very interesting to note that recessions actually usually start after the Fed pauses because the Fed usually waits too long. The Fed usually waits too long and it results in a recession. The recession results in an earnings collapse, and the market usually declines into that earnings collapse. And it's not until the Fed cuts 3, 4, or 5 times that the market has bottomed historically. Now, today things are a little bit different. You have all these option junkies. You have, distortions in pricing. Less people care about fundamentals. So the cycles might be shorter, but I don't think that history is completely irrelevant. I think that it will rhyme. It won't repeat itself. And I think by the time the Fed does cut rates, you might have several bank failures. You might have high increases in unemployment, and you might have a large number of corporate bankruptcies. And by high increases in unemployment, it's all relative. So you may be, going from, 3.5% to 5%, and that's a big move as a percentage. But it may not ever reach the 2008 levels of unemployment.
Yeah, or even the brief 2020 level, but that was an anomaly.
Yeah.
One last point about the Fed. Is it possible that they're really just preparing for this recession in the sense that historically, if you look at the number of basis points they've cut during a recession, someone pointed this out to me, it's usually about 500 basis points, 450 to 500 basis points during a recession. And so they need that
You need a
space,
high
that
starting point.
ammunition to cut.
Yes. That is exactly what's happening right now. The Fed is preparing for the next idiosyncratic shock or a slowdown in the economy. And if they had only hiked 100 basis points, one, they waited too long to hike. That's another conversation for another time. But if they only hiked 100 or 200 basis points, you wouldn't get the same effect because, you probably remember, the first QE, then QE2, then Operation Twist, then QE3, then taper, then QE4. Every time the Fed eases, they have to do more in order to convince the market. So, what they're trying to do is they're trying to create a situation where rates are so high that they're able to continue to cut in the next recession, so they can avoid doing a lot of QE. Because the Fed's balance sheet, reached almost $9 trillion, and it's going to if they do something like that again now that and they have to raise the Fed's balance sheet to $15 trillion, it's just going to lower the confidence the market has in the Fed. So it's all about credibility.
Right. Let's close off on the markets now. The VIX index has been on a downtrend, multi-month low. Is this a coincident or leading indicator for risk assessment in the market at all?
Well, I would say that the VIX is an interesting tool. I usually look at UX1, which is a front month VIX future, because that's something you can actually trade. But people have used the VIX indicator in the past, and because it looks at roughly 30-day volatility, it's been less relevant over the last year because people tend to trade a lot more in the 0 DTE and even the 1 DTE, or the 1 week option area. But, even in 2020, we saw the VIX hit 80 in 2008. I think you briefly saw, the VIX reach a similar level. I think at 13, with a 3-4% move down in the markets, you could see the VIX hit 25, 30. If you see that for a couple of days in a row. And I do think that it's not always a leading indicator because you can have several years, for example, 2004 to 2006. You can have several years of very low VIX, or for example, 1991 through 1996. But I think if it happens when there's a lot of uncertainty, it usually means that there's a lot of hedge covering going on, or people are aggressively buying calls versus puts. It's funny, today we actually saw upvol, call option implied volatility go up, which means people are essentially chasing the market higher. And I think what that tells me with where the VIX is today is that hedges are probably cheap, and you can probably, if you're long the market, you can probably buy very, very cheap protection. And it likely means that we could see the VIX higher and the market lower at some point in the second half of the year. Does it mean that the world is over, gloom and doom? No, it just means that the risk reward is not that great right now. There's euphoria and complacency, and I wouldn't be surprised to see a 5 to 10% correction at some point in the second half of this year.
Okay. Would you agree with this statement, which is that over the next 5 to 10 years, looking ahead, the potential for earnings growth in the equity sectors will be lower than in prior decades?
Absolutely. I would agree with that, but no one has a crystal ball. With the advancements in AI, what if you found out that, everyone that works at Chick-fil-A has been laid off and there's only one, security/manager and everything's robotics and driven by AI. So nobody can predict the future. And I don't want to be one of those talking heads on CNBC or Bloomberg that tries to make 10-year predictions and then is completely wrong. But I will say that given the high operating margins that we saw peak in 2021, 2022, I think that the probability that we are going to see peak margins in the next couple of years is very low, unless you have, some new technology that's going to revolutionize the markets over a longer period of time. Anything can happen, but in the near term, I think it's very unlikely that we'll see peak margins.
Now
That
you're
we'll see margins peak again.
Okay. Now your research in the Special Situations Research newsletter, which we'll put a link to in the description down below. People should check it out. It's part of it is dedicated to finding opportunities, hidden opportunities. You were telling me offline. So give us a special situation that people should be aware of.
Sure. So, we have a team of 9 people, part-time and full-time. We're all scrounging, and we have various Databases, we have a database of, 2,000 busted IPOs trying to find IPOs below cash. We have opportunistic shorts database. We have 300 closed-end funds trading below net asset value that you can arb and look at. We have a running list of 12 to 13 merger arb ideas that are very interesting. A couple really interesting names that, we have participated in recently were, one, World Wrestling Entertainment, given the bid from Endeavor to merge it with UFC. We were involved when the first rumors came out. That has been almost a 30% run for us. Another one is First Citizens Bank, FCNCA. When Silicon Valley went bankrupt, one of the interesting ideas what we saw with NYCB was when they bought um, SBNY's assets because the government you received an FDIC guarantee and you only took the best assets and you saw your deposits go up. The NYCB went up very dramatically. So when we saw the SIVB trade and that First Citizens was buying it, we bought that stock around 500, and as you can see today, it's over 1,200, and it's up almost 120% since we first alerted on it. Another really interesting name right now, over the last couple of months, we looked at is Burford. So Burford is actually a litigation trust where we made 80% actually selling puts, an implied volatility trade, after the U.S. court found a liability against Argentina and YPF. So YPF SA, as you may know, is a national oil company of Argentina. We had been trading it 10 years ago. Actually, at my team at Goldman Sachs, it was where Dan Ox started, who started Oxif, Dinakar Singh, who started TPG Axon, Eric Mindich, who started another eponymous $10 billion plus hedge fund. And Eric Mindich was actually involved in YPF 10 years ago in 2012. And what Burford did, so his fund was called Eaton Park Management, if you look it up in the filings. And what Burford did was it bought their claims because what Argentina did was they nationalized this YPF International Oil Company, the national oil company, and they never tendered for the shares of Inversora and Eden Park. So they essentially held this claim, and when the court ruled, this stock went from a high single digit stock to $12, $13 stock, and even after it started to rally and the news was out, people didn't understand it. So given my background, my history, and understanding the legal side of things, I saw that the implied volatility in the options, because people were buying calls, was very high. So I thought, okay, let's be smart about this and sell puts at over 150 implied volatility at the stock price before the news came out. So it would have to reverse the entire move from 7 to 13. So what we did was we sold all multiple option strikes right below $8 of 7.5 and below at over $1. So we're making the stock at 6.5 when it was trading above 11, and now it's at 12.60. So there are a lot of interesting ways we play the market through implied volatility by looking at special sits, merger arbitrage. There are things that people just tend to avoid. Another interesting name was Aerojet Rocketdyne, where we were looking at a pre-merger arb trade after rumors that GE was going to buy it. And then L3 Harris, there's a bid there. So that's kind of the flavor. And in the hybrid space, we're looking at a lot of companies that have high dividends. There's a company that we're still in process of doing work on, which is in the agriculture space, that paid a 40% dividend, paid over $30 a share in dividends last year, and the stock's down a third from the local highs. And it's an interesting space that's commodity related, and there's a whole sector of agency prefs in the REIT space that were battered during the gilt crisis in October, and we scooped them up at 70, 80 cents on the dollar. I'm talking about like a large number of issues where you can make 10% current yield, buy names at 75. On the move to 75 to 100 plus a 10% current yield, you're making 30% without taking equity risk. And we also think that there are a lot of stocks right now that still have a high probability of filing bankruptcy, but they've been meme stocks and high short interest stocks. I'm talking about the Beyond Meats of the world, where those companies could be 70, 80% lower by the end of the year. So I think that there's a lot to do. And just following kind of the AI mini bubble and following the options flow, it is one way to look at the world, but it's not, it's not a way to look for decent risk reward. And I think, the market has kind of been skewed towards passive and high leveraged option trading. Whereas, there are a lot of kind of layup trades in the market where you can make over 10% and not take a lot of risk. And that's kind of what we're focused on.
Okay. Well, I'd love to have you back on sometime and talk about M&A in more detail. And before I let you go, a little known fact about me. So I study finance, graduated from McGill. I wanted to go
Cool.
into
That's a great
banking.
school. Okay.
Yeah. Yeah. A lot of
Isn't it
my
like the top three schools in Canada, if I'm not wrong?
yeah, well, top ranked overall. For business, I think top three. Yeah. I
Okay.
went to the business school undergrad level for finance, and a lot of my smarter classmates, they actually ended up at Goldman and J.P. Morgan, and I never made it because I just wasn't cut out. But I ended up doing macro research, which I loved, and then eventually transitioned here. But my question is, I've always wanted to. Every time I had a chance to meet a portfolio manager or even a trader or anybody from one of the big banks, I've always asked them like, what are some of the traits and qualities that a firm like Goldman looks for recruitment. Now I understand it's a very diverse firm. You were on the buy side, but if you could narrow it down to a few things that people at these top banks and institutions look for when they recruit, what would they be?
Absolutely. I mean, I was actually in charge of recruiting some members on our team, both junior and mid-level, and was part of the process. And I would say that detail orientation is very important. And Goldman's a little bit different than other firms, so they tend to care also more about being polished and your appearance. I remember in my 360 reviews, they commented on my shoes. I'd buy my shoes from like Marshalls and TJ Maxx because we grew up poor, and they would say, "Oh, you need to dress better." But no, more importantly, I think it's detail orientation, general curiosity, and just being prepared. Reading about deals, reading about the capital markets, being prepared for the meeting are very important. And obviously being a team player. Those are things that come off right away. Those are four traits that people look for. And remember that certain firms are different. JP Morgan might be looking for certain things that Evercore may not be. At JP Morgan, they might be more focused on the soft skills, and they may care less. They might hire someone from a liberal arts school, and they may care less about their technical acumen. Whereas someone like Evercore, which is more of a boutique, you actually might make more money at a place like that. Might want someone with more of a technical background because they don't want to spend as much time training them. So it really depends on the type of firm, because you're specifically talking about banking. It really depends on the type of firm that you're interviewing for. But the basic traits of intellectual curiosity, detail orientation, being a team player, and being prepared, I think those four things are pretty standard across the street.
Have the hard skills requirements evolved over time? Like I've heard from some of my younger friends that now people look for Python on the resume. I mean, is that something
Yes,
that
that's right. Even some of the hedge funds like Point 72, like I actually used to be friends with the head of business development, one of the largest hedge funds in the United States, multi-managers, and he told me early on, I was actually looking to start my own hedge fund at one point, but the stress levels and my heart condition probably wouldn't be the best situation for that. But he was telling me that a lot of the young guys that are getting the biggest offers today in entry level, Python is a requirement at a lot of the big firms, and it wasn't like that when I was in the business. So yeah, I think it's another really important thing the skill to have, especially if you're looking at capital markets, equities. I doubt any of the M&A guys are using it. Maybe they are. But definitely if you're looking at trading, equity research, quant credit research, you should know Python.
do you think AI is going to eliminate a lot of the junior jobs?
Um, I think in the beginning it will supplement jobs. So there will be tools like Citadel, for example, is working with ChatGPT to actually create their own version for the firm so it can help speed up the coding process. At the beginning, I think it'll help with that, but eventually I do think it will replace a lot of the middle office, back office jobs, maybe even some of the front office jobs. Everything that can be automated, right? Call centers, support, trade settlement, those things I think will be automated at some point.
All right. Well, Jay, I really appreciate your time today. Very
Thank you,
educational,
David.
and best of luck with your mission, which is to educate the public. So, the Special Situations newsletter, we'll put a link down in the description below. Where else can people find your work? Where can people follow you, Jay?
Absolutely. So people can find us on Discord at the Special Situations Hub. We have 1,200 members in the community. You know, we have people on our mailing list from mega funds like Millennium, D. Shaw, even Goldman Sachs, but more from the personal accounts than their institutional accounts. But we have people who run their own multi-hundred million family offices, private equity professionals, CEOs of Fortune 1000 companies, and they're all sharing their ideas. So Discord, our website, which is more of a placeholder. Most of our information is shared via email or Discord, and on Twitter at Special Sits News, where we publish a lot of content, and I mean a lot of content for free. And we're also on we do podcasts and Spaces. We also do a video WebEx once a week with a couple hundred of our followers through WebEx, and you'll get an invite as a subscriber. So, you know, there are 4 or 5 ways to reach our team, and we plan to grow, in other mediums over time.
Okay. Well, congratulations again on your success, and best of luck with your growth. Thank you very much again.
Thanks a lot, David. Take care.
And for the viewers, thank you for watching. Don't forget to subscribe.